Bookkeeping Basics Guide and why this actually matters. Let me start with a hard truth. If you don't understand bookkeeping, you don't actually know how your business is doing. You are guessing. And yeah, you might feel busy, money might be moving, your bank account might not be empty, but without bookkeeping, you don't actually know if you're profitable, or your money is leaking, or whether your business is healthy or slowly bleeding out. Accounting is the language of business, and if you don't speak the language, you don't get to complain when things feel confusing. Now, here's the good news. You don't need to be an accountant. You do not need a finance degree, and this is not going to turn into a boring college lecture, hopefully. By the end of this video, bookkeeping will feel boring, and boring is exactly what you want. The best business owners I've worked with all had one thing in common. They tried to do their own bookkeeping early on. Not because they loved it, not because they wanted to do it but because once you understand the numbers, you gain control. If you absolutely hate bookkeeping, never want to touch it, hire. But if you want the best possible odds of success, you need to understand the basics. So let's break this down in the simplest way possible. The real goal of bookkeeping. Bookkeeping exists for one reason: to create financial statements. That's it. And there are only two that matter for 99% of business owners: the balance sheet and the income statement, also called the profit and loss. Everything you do in bookkeeping feeds into one of these two reports. The balance sheet. Think of the balance sheet like a photo, not a movie, a snapshot. It answers this question: at this exact moment, what does my business own and what does it owe? It has three sections: assets, which are the things you own; liabilities, the things you owe; and equity, what's left for you. The core formula is simple. Assets minus liabilities equals equity. And that one rule never breaks. Assets must always equal liabilities plus equity. If those don't match, something is wrong. If liabilities exceed assets, equity goes negative. That's not illegal, but it's a warning sign. The income statement. The income statement is different. It's not a snapshot. It's more like a movie. It answers, how much money did I make? How much did I spend? And what's left? It runs over time: a month, a quarter, a year, and it includes revenue, which is the money coming in; expenses, which is the money going out; and profit, which is what remains. Brief sanity check. Revenue numbers are positive. Expense numbers are positive. If you see negative numbers everywhere, something is probably broken. The two ideas that made everything click for me. I want to pause here because this is where bookkeeping finally clicked for me. Not because I learned more rules, not because I memorized debits and credits, but because I understood two ideas. If these land for you, bookkeeping stops feeling random. Idea number one: everything is one of three things. If you categorize a transaction, everything is always one of three things: an asset, a liability, or an expense. That's it. Yes, there are subcategories: cash, equipment, credit cards, advertising, utilities, but zoom out far enough and they all live under one of those three umbrellas. If you ever feel stuck, ask, is this something I own, something I owe, or something I spent? That question alone solves most categorization problems. Idea number two: money can only move in 5 ways. This is the second unlock. Money does not magically teleport. It can only move in 5 ways: money coming in, money going out, money being transferred, money I owe, money owed to me. Every transaction you will ever record fits into one of those 5 movements. Once you see that, bookkeeping becomes predictable instead of confusing. Double entry accounting without the jargon. Now let's talk about the thing everyone fears, debits and credits. Here's the truth. Debits and credits are not good or bad. They're not increases or decreases. They literally just mean debit equals left side, credit equals right side. Every transaction has 2 entries, always. That's double entry accounting. And I'll show you what this actually looks like. Example number 1, you get paid. A customer pays you $100. 2 things happen. Cash goes up on the balance sheet. Revenue goes up on the income statement. Money came in, 2 entries, done. Example number 2, you pay an expense. You pay a $50 electric bill. 2 things happen. 2 things happen. Cash goes down, expenses go up. Money went out, 2 entries, done. Transaction workflows and how this plays out in real life. Almost everything you do fits into one of 3 workflows. 1, getting paid, like invoices or sales receipts. Customer pays, revenue increases, cash increases. 2, paying vendors. Bill comes in, you pay it, expense increases, cash or liabilities charge. 3, taking money out or owner's draws. This is where people mess up. If you transfer profit to yourself, it's not an expense, it's an equity transaction. Cash goes down, equity goes down, income statement stays untouched. Never run owner's withdrawals through expenses. That's how books get destroyed. Banking in QuickBooks and why it feels off sometimes. One last thing that trips people up, accounting software like QuickBooks is always looking backward. When it syncs with your bank, it pulls yesterday's transactions. So unfortunately, your bank balance and QuickBooks sometimes your bank balance and your QuickBooks won't match exactly, and that's normal. QuickBooks will either match a transaction or add a transaction. Understanding this saves hours of frustration. Final thoughts? If this feels confusing right now, that's normal. Accounting clicks through repetition. Watch it again, then again, and eventually you'll have the moment where everything locks into place. Every accountant has had that moment, and you will too. But if you understand this foundation, you're already ahead of most business owners. I'll see you in the next one.